hi. Yes. So, hi. As you know, I'm Ronak Agarwal and I have been doing some technical analysis. No, not technical analysis, but yeah. So, I have been learning about the technical aspects of financial analysis because in a couple of days I have my interview at a particular company for a corporate financial advisor role. Today is 2nd of June. It's on 4th of June, so not a couple of days but 2 days. Last day we covered how to do DCF modeling and how to estimate the enterprise value and the share value of an enterprise. But now, today, I was looking at my academic projects, which are for my financial modeling and analysis assignment. I did a peer analysis and financial performance of UBS. Then for my principles of finance class, for the assignment, I did a CAPM and share price modeling. And for my this thing, capital markets assignment, I did a strategic investment and cross-border comp analysis. So on the basis of these projects, I was using Gemini to reference these projects to the job description and teach me what were the limitations to my assignment. For instance, looking at very simple cross-border comp analysis. So in this assignment, what I did was I was supposed to give share recommendation to a superannuation fund manager from two countries and tell them why they should invest in those shares. My approach was I am fascinated by Southeast Asian markets, particularly India, China, Singapore, Japan. These four countries I am fascinated by them. So my thought was I love my country. I'm gonna recommend Indian companies and Singapore. I love Singapore as well. So what I did was I took the top 20 companies from Nifty 50 and just give me a minute. STI, Straits Times Index. That's the index of Singapore. So what I did was I took 20 top 20 companies on the basis of market capitalization from the two index. And using that, I shortlisted 5 companies from each of the index to give recommendations. Primary recommendations were Singapore Airlines, Mahindra and Mahindra, Reliance, then Wilmar Industries, Wipro, TCS, then Singtel, Larsen and Toubro, and Keppel Limited. Now, the problem that Gemini told me was I did the comparison across two countries, but I failed to consider the sovereign risk while actually comparing. Sovereign risk is basically when you are comparing the share of two countries, there are certain factors which are not innately present in the multiples that we use to compare. Those risks could be the credit risk of the country, inflation risk, expected interest rate, expected inflation, these things. So these things are not innately present in the multiples. So what we need to do is we need to normalize the multiples to actually obtain the data, which facilitates comparison. So what we did was, I've already told you the methodology that I used for the project, but the limitations where I've discussed how different economic scenario can can impact. So the data needs to be normalized. And there is also mismatch in accounting standards. So what is mismatch in accounting standards? Different countries, they pertain to their local accounting treatments. There could be a discrepancy across countries, which leads to non-normalized uh, EBITDA and net profit, which is not exactly comparable because different accounting standards for different countries, they require different adjustments. So the question that arises was is the question that arises is now this is again Gemini. They are like comparing companies between emerging economy, supposedly with high inflation, and developed economy with low inflation. What adjustments would you do to the RV relative value or the choice multiple? So the answer to this is the valuation of companies. They are actually a factor of the growth rate being considered, cost of equity, and the return on equity. Now, due to heightened sovereign risks and inflation and higher interest, the required cost of equity increases, which also has a downward pressure on the multiples that we consider. So in that case, what was suggested that we use the PEG ratio. Now, what is PEG ratio? PEG ratio is price equity and growth ratio. So in that, we normalize the price equity ratio, that is the PE ratio. We normalize that multiple by comparing it to the country's expected growth rate. If it is an emerging economy, there is going to be a higher growth requirement because of the higher equity cost and higher everything. So no, sorry, my bad. So in developing nations, the cost of equity is higher, so the growth rate would be lesser because the returns, it goes to the investors. So we need to adjust the lower PE ratio with the lower growth rate so as to normalize the thing. So that's how we compare. Now the next question that arises is, where do we explicitly add the country risk premium to the CAPM equation to ensure target's sovereign risk is fully priced in the discount rate? Now, in case of cross-country transaction, it is essential to actually normalize the base discounting rate, that is the risk-free rate. So what we do is we add the country-specific risk to the risk-free rate in the CAPM. That gives us the minimum base level discounting rate that we have to use in order to value a company. This way, macroeconomic uncertainties, inflation, all of these factors, they are all they are already accounted for in the discounting equation. Second, the next question that we face is, if we are analyzing beta of an Indian company with the beta of Singapore company, is it comparable or not? If not, then how can we make it comparable? See, what is beta? We need to start with what is beta. Beta is how much dependence the company has on the market. The formula of beta is beta equals covariance of the return of the share with respect to the return of the daily return of the market divided by variance of the market. Now, why beta of India and Singapore are not comparable? It is due to the fact that both of them, they use different comparison points. Like if we were to find the beta of, say, Reliance Industries, we compare it with the return of Nifty 50. However, if we were to find the beta of Singtel, we would compare it to Straits Times Index. So there is no point of comparison between the two. Here what we need to do is we have two options. We can either, instead of using the local index, we can use a global index like MSCI All Country Index or MSCI World Index or MSCI All Country World Index, where we regress the return of these specific companies to the world index. Thereby we find the common basis. We find the common basis of comparison, like with respect to MSCI World Index, how is the performance of Reliance Industry with respect to, what was the example, Singtel. Another option we have is we multiply the normal levered beta of those companies with respect to the local index times the regression of the local index on the world, on MSCI World Index. This way we can actually normalize the beta to get a basis of comparison, to make the beta comparable. Now, this comes to our question, what is actually levered beta? Levered beta is the beta where we incorporate both operational risk and the financial risk. Operational risk is the risk of the business with respect to the economy or the market, and financial risk is the risk that the company takes in terms of their capital structure. The higher the debt, the higher could be the risk in that sense. So the question is, to isolate the pure operational risk of businesses, before making relative comparison, what is the standard step-by-step mathematical process we need to perform to this standard levered beta? I'll repeat. To isolate the pure operational risk of businesses before making relative comparison, what is the standard step-by-step mathematical process we need to perform to this standard levered beta? What this means is, when we are finding the value of a company, cost of equity specifically uses the levered beta. Now this part, it comes under relative valuation, that we are not valuing the company on the basis of discounting cash flow. Instead, what we are doing is we are using relative valuation. We are taking the multiple from the peer group and using the median to find the value of this target company. So the peer group is being valued on the basis of CAPM with levered beta. Even a target company is. What do? We, for each of the company, our given company, peer group, what we do is we take the levered beta obtained from CAPM and we unlever it. How do we unlever it? The formula goes like this. Beta of unlevered beta equals levered beta divided by 1 plus 1 minus t times debt by equity. That is the standard formula. Logic, we'll get into it later. So beta unlevered equals beta of levered divided by 1 plus 1 minus t times debt by equity. This gives us beta of unlevered of all the peer companies. Now what we do is we take the median of the unlevered beta and now we lever it. But we lever it using the debt equity ratio of our target company. So now, in order to lever the median unlevered, what we do is beta levered equals beta unlevered median, that's the median beta, times 1 plus 1 minus t times debt by equity. However, here the debt by equity that we are using, that's the target company's debt equity ratio. This way we get the unlevered levered beta for our valuation. Now, where do we actually use this? This is the beta that we use for DCF valuation. There is one step that we didn't cover the last time, that was the CAPM that we are using. The beta for cost of equity for WACC, it is this one. This normalizes the difference in capital structure between our comparables. So this way we actually get a comparable valuation. Now there is a very essential topic that we learned today but I didn't cover yet. So that is, what is relative valuation? This is the term that we've been using a lot for this video, but I did not cover it yet. So relative valuation basically works on the principle that it works on the law of one price principle, which states that similar assets having similar characteristics are going to have similar prices. There is not going to be any difference because similar characteristics. So there is no reason for there to be different prices. Now, there are two kinds of valuation for relative valuation. One is enterprise valuation. The next one is share valuation. For enterprise valuation, we have two options. One is enterprise value by EBITDA and enterprise value by EBIT. We primarily use enterprise value by EBITDA. Yeah, where EBITDA is a proxy of operational cash flow, and we only use EBIT for analysis and valuation of those companies which are very capital intensive and the depreciation in which depreciation is a recurring economic cost. So we take EV by EBIT. Now, how do we use it actually? What we do is we first identify a peer group on the basis of industry, market valuation, growth rate. Yeah, these are the basis in which we identify the peer group. Then what we do is we find the EV, enterprise value by EBITDA, of all the peer companies. We take the median and we use the median to value the enterprise value of our target company. How is that? We take the median times EBITDA. Now why is that? EV by EBITDA is actually the multiple that we are using from the peer group. That multiple times EBITDA leaves us with enterprise value that we actually need for the company, which will give us an enterprise value, in this case using relative valuation. The last time we covered enterprise value using DCF valuation. Now the best part is the value obtained from relative valuation should be similar to the value obtained from DCF valuation, because again law of one price, which says same thing will have the same value irrespective of which form we use to value it. Now coming down to share valuation, that is equity valuation. Yes, here we use the equity multiples. That could be price earning ratio or price to book value ratio. Now what is price earning ratio? Price earning ratio basically tells that how much money is an investor willing to pay for $1 return. Okay, so that is price market value per share divided by earning per share. Earning per share again is EAFESH divided by number of outstanding shares. EAFESH is earnings available for equity shareholder. That comes basically from net profit minus preference dividend equals EAFESH. Now, price to book value ratio, this is basically used by investors to see if the price is overvalued in comparison with the book value of the share. So how does it actually work? Price by book value ratio doesn't actually say much to us. What we actually do is we again take the peer group. We take the peer group, take the median beta and according median P by B, and compare it with a target group, target company. Now the question arises, what if the entire industry is overvalued? Suppose for a technology group, tech companies, there is no basis for valuation. It could be anything. There, in that case, we consider the return on equity as well. Return on equity is basically price by book value. Could be how, yes, price to book value actually says how much money are we willing to pay for the assets of the company. But there is no way to know whether the management is using the assets efficiently. There comes in return on equity, where price by book value compares how much we are willing to pay for the asset. Return on equity checks how much is the asset actually performing. So suppose PB ratio is low, but ROE is high. It means that the asset of the companies, they are being efficiently used. And again, price to book value is low, which means that company is performing well. It's underpriced. Suppose price to book value ratio is high and ROE is high as well. It means that company is fairly valued. Suppose ROE is low, but price to book value ratio is high. It means that people are willing to pay higher price for a company that is not performing well. In that case, it is overvalued. And if price to book value ratio is low and return on equity is also low, it means that people are not willing to pay much for the company because of the ROE. Another way of comparing P by B is, okay, so another way of valuing a company on the basis of price to book value ratio is justified price to book value ratio. Justified price to book value ratio is basically, it considers the return on equity and the cost of equity to actually see whether any value creation is happening or not. For instance, if ROE, return on equity, is greater than the cost of equity, it means that value has been created. And okay, first I need to give you the formula of justified price to book value ratio. So it is ROE minus G divided by R minus G. Return on equity minus constant growth rate divided by cost of equity minus constant growth rate. So here what we see whether value creation is happening or not. If return on equity is greater than the cost, then there is value creation happening. Justified price to book value ratio, suppose, is 2. Now, if price to book value ratio is greater than 2, if it's similar to justified P by E, then it's fine. If it's greater than justified P by E, it could be overvalued. But if price to book value ratio is lesser than justified price to book value, then it is definitely undervalued. Conversely, if return on equity is lesser than cost of equity, then there is no value creation happening. Instead, there is value destruction that's happening. In that case, justified price to book value ratio is going to be less than 1. And if PB is less than 1, if price to book value ratio is greater than 1, then it is definitely overvalued. So, coming down to how does comp analysis, comparable trading analysis actually work? So again, like I said, you identify a peer group on the basis of industry, size, growth profile, and margin dynamics. We do some financial scrubbing, that different companies, they have different financial year ending. What we do is we adjust their financial endings so as to have a standard 12-month period for our analysis to find normalized run rate earnings. And sorry, that was calendarization. Financial scrubbing is where we normalize the earnings and the data of the company to remove one time costs such as some lawsuit costs or asset write down. And in this way we use the data of different peer companies to value our target company. So I've been studying this since morning and I thought it's so much, but now I feel that it's going to be a very short video and this thing is never ending. So stay tuned for more. Thank you.